Welcome to the VA versus FHA Loan Comparison. Whether you're a veteran or active duty service member, reservist, surviving spouse, or a civilian buyer, this guide will break down every major difference between these two loan programs with real life experiences, simple side-by-side comparisons, and insider lender tips that you won't hear anywhere else. And stick with me until the end because we're covering everything from myths that cost veterans and buyers money to how each loan affects your monthly payment to hidden lender math behind qualifying, including the grossing up rule that can make or break your approval. And if you're serious about getting the right loan for your situation and keeping more money in your pocket, this is your roadmap. Hi, I'm Alex Ramirez and I help veterans and active service members and home buyers navigate the mortgage process with confidence. And don't forget to like, subscribe, and tap that bell so you never miss any of my weekly updates in the future. Okay, so now let's dive in. The big picture. Let's start with the basics. What are these loans designed for and who can actually get them? The VA loan, specifically for eligible veterans, active duty service members, certain National Guard and Reserve members, and some surviving spouses. It's backed by the Department of Veteran Affairs, which guarantees part of the loan to the lender. This reduces the lender's risk, allowing them to offer lower interest rates, no down payment, and no monthly mortgage insurance. And there's also lots of flexibility. No official minimum credit score from the VA, although most lenders prefer 620 plus. Eligible property types, single family homes, VA approved condos, and certain multi-unit properties as long as you live in one of the units as your primary residence. Some manufactured homes with extra requirements. And the FHA loan, it's available to any qualified borrower. No military service is required. It's backed by the Federal Housing Administration, which ensures the loan for the lender. And is designed to make homeownership accessible to buyers with lower credit scores or limited savings for a down payment. The FHA minimum credit score is 580 for 3.5% down, 580 to 579 for 10% down. Allows a wide range of property types, but must meet FHA approval standards. I can't tell you how many times I've come across people who've told me their loan officer or even their real estate agent said they needed to go FHA, either because VA loans are too hard to do or because the seller won't accept the VA offer. This is why it's so important to work with professionals that specialize with VA loans. So VA versus FHA comparison, who qualifies? So FHA loan, basically anyone can do an FHA loan, whether they served or they didn't serve. A VA loan, you had to have served in the military, or you also have to be a surviving spouse. So down payment for a VA loan, 0% required. FHA loan is 3.5% for credit 580, 10% if your credit's 500 to 579. Credit scores. VA has no minimum credit score. Lenders often want about 620. FHA loan 580 plus for 3.5% down. 500 to 579 needs 10% down. Monthly mortgage insurance. VA doesn't have monthly mortgage insurance. FHA, it does. It's for several years and sometimes for the life of the loan. And it depends how much you put down. Upfront fee. VA one-time funding fee is 1.25% to 3.3% and can be waived for certain veterans if you have a 10% service-connected disability. FHA has the upfront mortgage insurance premium of 1.75%, which is financed. And the loan limits, the VA does not have any loan limits if you have full entitlement available. FHA, it's going to be county-based, so every county is going to be different on the max loan amount. And interest rates. VA often has low interest rates. FHA is very competitive, generally pretty close to VA, but the big difference maker is that monthly mortgage insurance that you pay. Closing cost rules with VA, limited on some fees. FHA has fewer restrictions. So VA loan and FHA interest rates are typically very close, but there is one thing to remember, that FHA has mortgage insurance and VA does not have any mortgage insurance. FHA loans always require mortgage insurance, which adds to your monthly cost. VA loans never require monthly mortgage insurance. FHA does have more flexibility in approving lower credit scores, making it ideal for buyers who don't qualify for VA or conventional loans. If you do qualify for a VA loan, VA is very lenient with qualifying as well. So let's talk about the grossing up difference when it comes to income. This is one of the most overlooked differences, and it directly affects how much home you can afford. So grossing up equals lenders increase non-taxable income when qualifying you for a loan. Like your VA disability income that you may be receiving, that income is grossed up. Why? Non-taxable income goes farther than taxable income because you're not losing a portion to taxes. VA and most other loan programs can gross up non-taxable income by 25%. The big difference, FHA loans can gross up the non-taxable income by 15%, so you're losing money. Here's an example calculation. $2,000 a month of VA disability income. VA loan, $2,500 of qualifying income, that's grossing up 25%. FHA loan would be $2,300 in qualifying income, that's grossing up 15%. The impact, $200 difference in qualifying income. That can mean thousands in extra buying power. That difference could qualify you for $20,000 more in a home price or push your debt to income ratio low enough for a loan approval. And if you reach this point in my video, I know that you're either ready to make a move now or you plan on doing something in the next few months. And if you're ready to schedule an appointment right now, check out my description, hit that Calendly, and then schedule an appointment with me. Or you could also call me or send me a text message at 805-857-3708. That'll go directly to me. Okay, so the long-term cost impact. Upfront costs are important, but your long-term costs are where the real savings happen. So here are the FHA loan costs. Upfront mortgage insurance premium, 1.75% of the loan amount, and this can be financed. Most people don't pay this out of pocket. Monthly mortgage insurance premium, or MIT, is 0.15% or 0.75%. Depends on the down payment, but it's often required for the life of the loan if the down payment is less than 10%. Here's an FHA example. On a loan of $300,000, $5,250 is upfront mortgage insurance premium, $204 a month for the monthly mortgage insurance premium. And the VA loan costs, one-time funding fee of 1.25% to 3.3%, or it's waived if you have a service-connected disability with at least a 10% rating from the VA. And there's no monthly mortgage insurance ever on this type of loan. So here's a case study. Two identical buyers, one VA, one FHA, buy the same home for $300,000. Over 10 years, the VA buyer pays about $24,000 less even after adding the funding fee. That's a huge savings that can be used for investments, paying off debt, or building a financial cushion. VA isn't always the winner. So here's when FHA might be better. When you're not VA eligible. So you're not a veteran on active duty or surviving spouse, or maybe you're a reservist or National Guard and you just don't have the minimum service requirements to qualify. Or you've used all of your VA entitlement on one property or multiple and you're looking to buy another home with a very little down, and the new house you want to buy is at least 100 miles away from your current primary residence that the VA loan is on. Here's a simple decision-making framework I use with my clients. If VA eligible, VA loan is almost always the better choice. If not VA eligible, FHA is a powerful tool for getting into home ownership with very little down. If you want to see exactly how much more home you could qualify for under VA versus FHA, schedule time with me, go to my Calendly, it's all in my description, or you can just send me a text message or give me a call. And remember, you've served, you earned it. Now let's make sure those benefits work for you and your family. Let's get you home.